Welcome, folks. Brandon Chapman with you today. It's not my normal slot, but it is my new normal slot for Thursdays as Blake is taking Mondays. We'll be doing here. It's for the kind of the switcheroo for the next 5 weeks, and we'll flip back. But it's good to be in the middle of the week to kind of see how things have transpired, what kind of movement we're seeing at the moment. Boy, today it gets kind of interesting as we have so far been able to shrug off relatively poor earnings or poor guidance. And today it just seemed like those opening gaps on stock like Disney, for example, just couldn't hold and they faded from the highs. Are we getting skittish as the market's testing new highs and high levels, extreme levels? Are we looking for a correction? Is the Fed and next week's inflation data going to cause some concern for investors? We'll kind of explore how the markets are reacting today to those potential developments over the coming week and further news on the earnings front. As we look at the S&P, you can kind of see we kind of ran higher. We tested the highs over the last little bit of a week and we just drifted towards the close today. When you look at this from an intraday perspective, you can see right around market open, it was just a slow bleed all day long and eventually kind of stabilized as we went into the market close here at 14. So you just see that just continued selling pressure. What was causing this? I mean, there's a number of factors that we don't know always why something happens. But one of the things that came out was a particular trade yesterday in the options market on ES, speculation over who it may be. But you look at the open interest here, 21,000 contracts. The volume yesterday was actually over 25. Point being is there was some sizable trade coming into the options market, expected to be long at the 40-50 strike for next Friday's expiration. And so all of a sudden we start to create this level. We start to create kind of a sentiment. The potential as we break below 4,100 and approach 40-50, this may squeeze things further and drive the market on an accelerated basis lower. But at a minimum, it kind of gives us an expectation for where the market may be headed here, right? 40-50, break that level. It's kind of an area of support as well. We may begin to push lower, which really works well. I mean, if you're familiar with any of the Ultima strategy, Don's got some calls up here he's sold as part of that. And these little pullbacks can provide a tremendous amount of relief as you close them out for 50% gains, right? Puts are already closed out. Now you look to close the calls out. And so anyway, it provides this opportunity if we see the slippery slope. So with inflation data on tap next week, ramped up inflation expectations. In fact, if we look at /ZQ over here, we'll kind of see, and I got to flip this to futures. But you'll notice is that this line is pushing a lot deeper. This is current. This is going back to, for example, on November 1st. And you'll notice this is getting steeper here as we're pushing below the price point that was priced in November. So this is, you can see 97 down to 95. 100 is the highest. That would be a 0% Fed funds rate. And so we're seeing this line get kind of pushed a bit deeper down here. You'll see 4.875. Now all of a sudden we're starting to price in a 5, 5.25, maybe a small probability of a 5.25, 5.5. We're starting to buy into what the Fed has stated is their goal. And yet, as we look at the back half of the year, you're seeing expectations as the red line's rising that the Fed is going to start to cut rates at the end of the year. So we're trying to figure out, what is the Fed going to do? And right now what you're seeing is that, maybe we're starting to realize that higher interest rates are not exactly the most bullish for the market. And so we'll see. Do we break lower here? We're still trading in a pretty nice channel over the last several weeks. What I'll kind of comment on this front is that it's not like the volatility markets are really signaling a major decline. Now, there are those out there calling out the VIX because there's not a lot of trading in the SPX options out 30 days. A lot of it's pushed to 0 days to expiration. Again, we saw that print from yesterday that was 7 or 8 days out. A lot of it is pushing to shorter amounts of time, but I still believe that the market is fairly efficient in pricing in the expectations regardless of whether or not there's a lot of activity at the 30-day level. But you'll see the VIX did rise today. The VIX 3M plus VIX ratio declined. We're about 1.08, which means that the 3-month VIX is 8% higher than the spot VIX. If we look at where the skew went today, SKEW, did we rise or fall? Normally, as the VIX rises, the skew falls. So from my perspective, we may see the market pick up, but we are certainly in a position right now. We could pull back a bit. We could pull back to that significant print we had about 399 on the SPY, and maybe settle in here and give it another go back to 420 again. And then we may see some of those volatility-based indicators begin to ramp up, back month volatility, front month, the skew, etc. But this is certainly outside maybe the scope, and that's why we saw the VIX rise a bit today, a bit outside the scope and maybe a bit unexpected. And also to help kind of the backdrop here is that, we had a bit of a breakout last week in Treasury yields. This is the 10-year Treasury yields up, price down. And we kind of consolidated yesterday, gap lower today, rallied on a really poor showing on the 30-year Treasury bond auction. And so are we setting up here for a potentially higher low off a little above 3.6%? Do we start to push back towards 44% again? We got some lift in part because yields have come down. If yields begin to rise here, pricing in higher expectations. So we look at the 3-month T-bill, it's pricing in 4.6%. Well, if the Fed is going to 4.75% to 5% in the next meeting, and maybe by April, May, we're pushing 5.25%, this has got to reprice at much, much higher levels. What does that mean for the 30 and 10 year that right now is dragging behind at 3.6, 3.7%? If the Fed funds rate goes to 5.25%, should the 10 be at 4.25% in here, somewhere in this band? That means further pressure on treasuries if the treasury market is pricing in those higher interest rate expectations. And inflation coming up next week, the data may come in hotter than expected, could come cooler. Point being is it may pressure interest rate expectations. But what we got from Powell the last week, and his talk yesterday, and then the press conference last week, is he's kind of expecting that inflation may start to pick back up again in summer, although he still believes he can get down to 2% without having to see a recession. That may be optimistic because the bond market's pricing in recession, but they may have to price in, which means higher yields on longer term treasuries. They may have to price in the fact the Fed may have to raise higher than many thought, just a couple of weeks ago. And that could have a significant impact on the market. When I say significant, what does that mean? Maybe a pullback to 399, right? Maybe a pullback even to 380. We'll have to see how things play out. Again, it's just looking at levels. As you break one level, you look at the next level. But at least right now, that 400 level seems pretty significant, that if we get a little skittish going into the weekend as yields rise on treasuries and pressure stocks, and normally that does accompany a stronger dollar. You'll see gold today faded from its high. If we look at UUP, this is the dollar against a basket of currencies. We gap lower and rallied, but for all intents and purposes, we did have a stronger dollar today. And this is a trend. Gap lower and rallied. We're seeing stronger dollars throughout the course of the day. We may see this continue as gold breaks support, as it looks like we're kind of in the mode of doing right now. And the dollar against the euro and other currencies relatively strengthens. And this would pressure stocks as well. So be careful of the downside. Again, while the volatility markets are not exactly pricing in a major correction right now, it doesn't mean we can't test historical support or resistance levels, 4,000, 39, 38 over the coming weeks if the dollar does strengthen. I wouldn't expect kind of a quick sell-off, a furious move lower. We'll probably see the VIX constrain itself a little bit. But again, there's still the possibility we pick up quickly and start to move higher, albeit on a slower basis. As the VIX falls, you probably expect skew to rise, which would set up for that next correction. As we look at a handful of stocks today, so as we go back to companies like Microsoft as an example, Microsoft had a pretty nice little kind of topping formation here, a gap and fade here. So as we take out this low, we may see further downside in Microsoft. You saw yesterday there was a lot of call activity. You break 280, we may have a chance to really begin to push the gamma squeeze, and it just never materialized. And we began to reverse heading in the close today. So again, the good faith that was extended back here when Microsoft essentially beat analyst estimates but lowered expectations or guidance, the stock initially gaps lower and then made it all back and began to run. Capital One Financial, a stock that missed expectations. This is actually not adjusted or non-GAAP earnings. Missed expectations, but really set aside a lot more money in loan loss reserves. Some stuff looked better than expected, but for all intents and purposes, the stock gapped and then made a huge rally intraday. It seems like we're seeing the exact opposite right now. We're not exactly willing to shrug off minor irregularities with earnings. So, for example, Disney had a huge gap up, but they lost subscribers for the first time to Disney Plus. We're seeing layoffs, right? So the silver lining was ignored, and we're starting to look at the apple, right? Think of Snow White, right? The apple, Sleeping Beauty, the apple, right? We're taking a bite. We're realizing the apple may be rotten to the core. In this case, Disney sold off pretty hard, creating a very bearish belt hold pattern up here, establishing a very significant resistance at 118. And we start to see follow through here. We may see Disney correct a lot more. And again, right now we're basically taking the exact opposite stance we took, literally just a week or two ago with Microsoft and Capital One. And right now we're beginning to focus on the negatives of earnings. And again, maybe we're refocusing on Microsoft, for example, with today's selling and recognizing, well, the earnings weren't exactly as great as you thought. And we see this gap and fade here. We could see this pull back to the 96 to 105 area. And that'd be a very typical pullback. But as you look at Disney, you look at the channel that's trading in right now, what you see is that, again, we start to break below our lows here. We may see a deeper retracement in store. Another stock today that announced earnings was ABBV. ABBV, the initial reaction was very, very positive. The company, has its Humira, a drug that's seeing competition kind of eat into stuff. Then you've got your, what is it called? Skyrizi. I don't know, whatever, however you pronounce it, which is like your psoriasis, arthritis, and Crohn's disease drug. Sales increased by like 70+% of that. The silver lining, maybe Skyrizi early, but notice the fade that we saw today as people took opportunity to sell ABBV into strength and really beginning to focus on the fact that they're not seeing as much growth in some of their drugs. And the forecast for strength is really 2025 from the CEO. So all of a sudden we see that selling off of the initial optimism, the exact opposite of what we saw from Microsoft just 2 weeks ago, right? Let's go back to Microsoft and take a peek here. What day was it? Yeah, 2 weeks ago. It was on the 25th of January. Another stock today is Duke Energy, right? So you think rising yields generally is not favorable on the 10-year, 3-year, are not very favorable. Rising borrowing costs, right? Higher Fed funds rate. It's not great for utilities. It looked like there was some optimism last week with Nextera here starting to make a move. It dropped after a big drop on its earnings. But again, we saw option activity come in Nextera last week, but Duke today breaking support, kind of completing a head and shoulders type formation here with this as the neckline. Well, what is that forecast? When you look at the pricing on Duke Energy off of its earnings, say 99 to about 106, about $7 puts you back at 90. When you look at the percentage retracement of that at that kind of $90 area, we're looking at even below the 61%. We may find ourselves back retesting lows if we continue to see yields rise here, which is not going to be great for real estate, for example. It's not Rago, obviously not great for utilities, down 1.37% today. Google, after the huge gap up about a week ago, let's take a look at Google giving up its gap on its earnings, for example, some of the issues with regards to its AI, et cetera, creating pressure. But the reality is, again, we're starting to take a closer look maybe at the earnings or the lack thereof, and just realizing that we got a little ahead of ourselves in terms of the expectations. Another stock announced earnings today was Pepsi. Pepsi, again, gapped up and faded. So again, we're failing to kind of look at the positives. And as we went throughout the course of today's trading session, we began to focus a little bit more on the negatives. And this, again, is the exact opposite scenario that we had on Microsoft and Capital One. Again, going back to this date right here on the 25th. And in fact, in my session, and we talked about, SPY on that particular date here, the 25th right here, and indicating what? We had this significant print the day before at 399 saying, look, we take this out, we're running to the next level. What's the next level? You go back, you say, look at the ties here. And that's kind of where we're getting stymied right now. The next level beyond this would carry it to 430. And so again, as you look at how the market is responding to earnings like the 25th, it looked like we were going to run to the next level, which we did. Now we might be pulling back to that previous level, giving back all these gains of the last 2 weeks and starting to price in what we may be in store in the future. Now, again, I'm not expecting a major sell-off here going to 330. This may delay a little bit, but at least right now it looks like we are kind of in a short-term pullback mode. In fact, Don put on one of his catapult spreads yesterday, buying an out-of-the-money put spread on QQQ and selling puts on the SPY, hopefully making 50% on both, right? The idea is that if the Qs can drop to, in this case, again, putting on yesterday, kind of this 290, 280 level here. And again, you don't need it to get there because you sell puts against the SPY, and that's helping buy the finance the puts. You have a net credit. So again, these kind of what he calls catapult trades are really nice because you're not footing the bill that if it doesn't make the move you expect, you still have a chance to walk away profitably in that scenario, but just not as much. Finally, kind of wrap things up here with LYFT. Now, LYFT, again, earnings treachery, but you'll notice back here, we've made a nice move higher in LYFT. Do the earnings justify it? Minus 57, minus 108, 118, 161. This company's losing money. You could look at operating cash flow to see if there's any silver lining, but as we know right now, at least for today, the market's refusing to look at the silver lining and beginning to focus on the more negative aspect of earnings. A lot of companies, because a lot of the earnings that have come out have not been picture perfect, and as a result, but they've shrugged off that kind of the negatives and focused on the positives. At least for today, it looks like we're focusing more on the negatives. For LYFT, that means if we look at an intraday chart here after hours, we closed right around $16, a little bit over. Huge decline, testing 11-ish after hours here. That's a major decline in LYFT, like 25+%. $5 move lower. You'll notice the pricing right at the close day was only looking for a $2.10 move. That's the $1. That's the one standard deviation range, plus or minus two. Two standard deviations that should capture approximately 95% of prices. That's only a 430. You got to go 3 standard deviations, at least after hours when we're at 11, maybe even lower. A 3 standard deviation move. Again, that 1 percentile of movement, at least after hours. So we'll see what happens tomorrow with LYFT, but the after hours price action is not good as a result of the earnings. And right now, it seems like we're turning a blind eye to any positives, and we're starting to focus on the negatives. And at least for today, very different position from what we saw on the 25th of January that led to this last little rally in the market. Well, anyway, folks, we got a lot of stuff coming up. Again, we got end of week. We'll see what happens tomorrow with the market. At least after hours, looks like we may be kind of angling lower on the session as we look at ES. But again, we'll see what happens tomorrow as we approach the weekend. Do we hold? Do we buy going to the weekend? Or do we start to take some profits because of the rally we're seeing? Is that option activity yesterday on the ES reflective of the sentiment of wanting to hedge, wanting to reduce their positive delta? Tomorrow will let us know. Anyway, have a great one. We'll see you back next week.